Well, as we know, a run on deposits brought down Silicon Valley, Signature, and most recently First Republic. Will more banks be pulled under by this deposit run riptide? Here to break down the outlook is Gerard Cassidy, RBC Capital Markets Managing Director. Good to have you on the show here. So a lot of people wondering, is this deposit flight over? Is this contagion now contained with this rescue now from JPMorgan?
I think it is, Rachelle. In fact, when you look at the business models of the three banks that had these deposit runs, those business models are very, very different than your typical bank in the United States. And when you take a look at the core consumer deposits, those are the deposits less than $250,000 that are insured in a company like Silicon Valley, they were less than 3% of total deposits. Whereas your typical regional bank in this country has anywhere from 40 to 60% of the deposits less than 250,000. So that's why we're confident that the run that you've seen in these three banks will not be replicated with other large banks.
And First Republic didn't share the exact same risks as SVB and Signature Bank, but why do you think there was continued pressure on First Republic then that got it to this point?
Very good observation, Rachelle. You're right, the risks were quite a bit different. And when you take a look at the First Republic funding, they all had the issue with funding. That's what's caused these problems for these banks was deposit runs or deposit flight. And anytime you have deposits that are over 250,000 that are not commercial operational deposit accounts, they're susceptible if there's a fear that there's going to be some sort of loss when you mark to market the asset side of the balance sheet because rates have risen. That money is susceptible maybe to leave, and that's what, of course, happened. Now, if we didn't have a Silicon Valley, we certainly would never have seen what has happened here at First Republic.
That's one of the things that makes it sort of tough to predict, the next shoe to drop or just how long we're going to be feeling the repercussions from this. And we did note Jamie Dimon saying this was the government asking, big banks to step in here. And it did require that regulatory waiver given the size of JPMorgan already. So what does this do then positioning wise for JPMorgan and these other big banks now that it's essentially gone over that 10% threshold?
True, and JPMorgan Chase and Bank America are over those 10% thresholds, and you're permitted to go through them through organic growth, but you're not permitted to make acquisitions unless the government invites you in a failed situation, which is what we have in this case with First Republic. And so I think what you're seeing is, even though you take a look at the market here in the United States, it's still a fragmented market when you compare it to a Canadian market. So if you look up in Canada, there's basically 5 banks that control the banking markets up there, and they all have anywhere from low 20% to mid 20% market shares. Here in the United States, as you pointed out, JPMorgan Chase is the largest, but their market share in deposits is in the low double digits, as you mentioned.
And as we speak about JPMorgan, that was one of the banks that Warren Buffett's Berkshire Hathaway started reducing positions in. But that was obviously starting back in 2020. But they also added Goldman Sachs, Wells Fargo, M&T Bank and PNC Financial to some of the areas they were reducing their holdings in. What do you think perhaps Buffett was looking at when he saw this and how much we might actually potentially hear about more of that?
I do think you're going to hear more at their annual meeting about their bank stock investing strategies. Over the years, as you pointed out, Berkshire Hathaway has been a bank stock owner. They have less exposure today to the banks. I saw Charlie Munger was quoted in the Financial Times being a bit concerned about the commercial real estate exposure that the banks have. So I certainly expect them to discuss that further at their annual meeting as well. But through the cycle, with strong banks like a JPMorgan or a Bank America, investors still can make money. And we have to remember, Berkshire Hathaway has got a good track record of being able to step in a time of distress and make an investment and do very well like they've done in the past. They just haven't had the opportunities yet to step in situations that they find favorable to them.
And it's interesting because they did also start building up some more positions in Citigroup, Ally Financial, Jefferies, New Bank, Bank of America as well. So is it about a bifurcation of what we're seeing in terms of the banking industry, or what do you think is driving some of the areas that they're choosing to build up in for these banks?
I think it has a lot to do with value. When you take a look at the numbers, we don't cover Jefferies, but Ally, Citi, and Bank America, particularly Citigroup, stands out when you look at their stock relative to their book value or tangible book value. It's trading at a significant discount. And when you look at a value investor like Berkshire Hathaway, that makes it very attractive to an investor who has a long-term view when they come to making investments. As you know, that's the approach that they've always followed. Same thing with Ally and Bank America. Their discounts are not as substantial as Citi's, but they are discounts to book value. And that's what they look for as a value investor.
And certainly that signature move of playing the long game there for Berkshire Hathaway and continuing that even in their approach to banks as well. A big thank you to Gerard Cassidy, RBC Capital Markets Managing Director. Thank you for joining us this morning.